And welcome back again to Tim Biggam's Big Time Options, Edges and Hedges, taking a look at our latest UOA unusual option activity. Today trade on SanDisk SNDK as the luster has finally come off of SanDisk stock, but the luster still absolutely remains on SanDisk option prices as IV continues to climb higher, now reaching extremes, and a couple trades to take advantage of the high IV now that the stock has stopped flying up. So let's jump in and take a look, shall we? First of all, we always like to take a look at using like this. A fusion approach combining fundamental, technical, and more importantly, implied volatility analysis. So let's jump in and take a look, shall we? First of all, here is the scan from the day when we saw that big option volume coming in. As far as the amount of it certainly has gotten extreme, to say the least, right? You can see that SanDisk reached the top on a couple of the different strike prices. IV, as we'll see in a second, reaching the 100th percentile, so the highest options have ever been, right? We can also take a look at a different scanner, right, with SanDisk here, as you can see, again, over 350,000 options traded, more than double the normal volume. As we said, IV now at the 100th percentile. We'll take a deeper look at that in just a second. We always like to look at valuations, as we said, so you can see that the valuation certainly getting stretched. SanDisk only been around for about a year and a half now as far as a standalone stock. It was a spin out, right? But you can see price to sales, which had been hovering, around that 5 times level, right, for most of the previous year, right? And certainly to begin this year, then has exploded higher since basically April, reaching at one point 25 times price to sales, now has tempered somewhat, still at a very rich, to say the least, almost 20 times price to sales. Certainly the analysts, their kind of price targets, most of them like the stock, but the highest price target is 3250, 3,250, right? The average is 2,000, which we kind of use on a couple of our trades. We always like to look at the implied volatility, as we said, and taking a look, here's the implied volatility. Pulled off the 120-day. You can see on Thursday, we were closed Friday for the 4th of July holiday, but IV just exploded again to by far the highest reading over the past 12 months. You can see it lifted across the entire IV spectrum, right? Term structure vol lifted on both the long and short end, right? And you can see just how much from Wednesday the 1st to Thursday the 2nd, right? That huge lift in implied volatility from 110 to over 120. So IV now reaching a new high, right? You can see the long-term IV again shooting up along with the rest of the IV, again, 100th percentile. Pulled off a couple charts. Here's a 2-year chart, basically the longest all of the history, if you will, of SanDisk options, right? Of a 50 delta 360-day call option, right? The IV now at by far the highest level we have seen. You saw this huge lift, right, as SanDisk kind of entered the AI space, if you will, from storage, right? But it did temper, right? Pulled back and hugging kind of that 100 IV. Now we're at well over a 110, right? Looking again for it to pull back, to temper somewhat, right, over the coming weeks or months, right? I pulled off the same IV chart, 360-day, 25 delta negative on the put side, obviously. You can see the exact same chart with that huge spike that we saw over the past couple days. And here's a shorter term look over the past 3 months on the puts and calls, both, right? Calls in blue, puts in green, right? And you can see both now reaching by far the highest levels we have ever seen, which favors selling these options. So sets up for a couple interesting trades. One being a simple sell strangle, right, on SanDisk, right? So going out to December of 2028, the longest term options they have, selling the 1500 put, which is out of the money. SanDisk closed at roughly 1750, right? Out of the money by about 250 points. And the 3500 call, which is out of the money by 1750 points. So about 100% out of the money, right? You can see it closed at 1645, right? So in essence, you have zero downside, right? Because if SanDisk happens to go belly up, right, you're bringing in more premium than the short put strike of 1500, and you have a massive cushion to the upside on the calls, right? So simply did a quick look at it here. The stock at 1745 where it closed, upside out of the money, 1755 points out of the money, right? Over 100% out of the money on the call side. The put still 14% out of the money. Believe it or not, the delta on the trade, if you sell the call, sell the put, you'd be negative 54 deltas. Why? Because of the huge jump in IV and the long-term nature of the trade. So you can see here the delta on the put is minus 15, the delta on the call 69, hence you get a negative 69, positive 15, so you'd be 54 deltas net short if you did the trade. The IV 110, right? So you're looking at the IV of 113 roughly on the put side and 108 on the call side. So selling 110 IV, really just looking for it to temper back towards that 100 level again, right? Seeing that huge lift that we saw here, right? Just looking for it revert back somewhere down around here, right? And that would certainly be a huge benefit for the trade. Also took a look at the trade on going to July from July 3rd when we put the trade on here at 1645. Compared that to June 5th, right, with the stock at roughly the same price, 1759.68. And you can see that selling the 2700 call, not the 3500 and the 1500 put, would get you the same net credit, 1645, right? Why is it so much more now? Why do you have 800 points more upside cushion now versus then a month later, right? Because IV has exploded from around that 100 level to that 110 level we're at right now. So this sets up ideally for that trade. Taking a look at the Theos here, right, you can see if we did the trade today, we'd be selling it at about 1620, 1625, right? Selling the out of the money 3500 put, 1500 or 3500 call, 1500 put for about 1621. Deltas, we said, be negative 54 deltas, 69 and 15 here. But if we just drop IV 5 vol points, just 5, right? So really just looking for it to move from where it is here to back to this level here, basically this latest spike up. So we're not looking for a huge pullback in IV, right? But you can see how much that means. The theoreticals now drop to only 1539 from 1620. So roughly an 80-point gain on the trade simply because IV pulls back 5 vol points. The delta too, you become less short, right? Because the call delta as a function of IV drops. The put delta increases a little bit. The call delta drops about 2, vol points delta wise, drops 2 deltas. The puts increase about, 1 delta. So you'd be net delta only 51 short, right? So certainly sets up ideally, right, to capture that. And you have plenty of time decay, right? The theta on the trade, 61 and 29 here. So you're looking at grabbing, close to $1 in time decay, right, premium going forward here. So it's away 85 cents, as you can see here on the theta. So you have about 2.5 years to expiration, right? So your upside break even, right, which is 3,500 plus the premium received in, on the options both sides of the trade, right? Selling that straddle and strangle in this case for 1645. Your upside break even would be roughly, right, 3,500 plus that 1645 would be 5140. I use 1640 just to make it a little bit more amenable as far as execution. So your downside break even, as we said, no downside on the trade at all, because the short strike price, you're bringing in more premium, 1645, right, than the short strike price you're selling. So you have literally no downside, right, which then allows you, again, to hedge by selling shorter term out of the money put spreads to bring in more premium if you want to chop wood, as I call it. So a great way to do that, you have 2.5 years, right, to hedge the trade if you want, waiting for this huge jump in IV to revert somewhat, right? So you have a massive amount of time to then continue to chop wood, sell shorter term out of the money put spreads, bring in, $1 or two a month. It certainly can add up over the course of 2.5 years. So in order for you to get in trouble on the trade to the upside, you have almost a 200% upside cushion, because the break even on the trade, right, 33.95, right, on the trade, you have 3,395 points, right? Your upside break even, as we said, 5140. So you need the stock to rally almost 200%, right, over the course of the 2.5 years to get in trouble on the trade if you held it to expiration, which annualizes to over a 50% gain on the trade. So hopefully provides insight how we go about identifying trade opportunities here at Big Time Options. So until next time, as always, here's the good trading. Take care.